so let's talk about selling an item and if you're going to have a gain or a loss. And this is kind of fun. So on January 2nd, we purchased fixtures for $12,000 in cash. We expect for 5 years, and they're going to do a double declining with no residual value. So then on October 16th, they sold the fixtures for $5,900 in cash. So let's go ahead and figure out how we're going to do both the depreciation and the sale. So let me just start with another page here. Okay. So we're going to do the double declining depreciation method. So 12,000 is what we paid. And then we expect the fixtures to remain in service for 5 years. Now, if you were going to do straight line at 5 years, it would be 20% per year. So we're going to go ahead and double that. So 40%. And they don't expect any residual value, so it doesn't matter how low that we go. So we bought it January 2nd. So let's go ahead and depreciate for the first year. So we're going to take our value, and then we're going to take this times this. So that's what we're going to depreciate for the year. And so what's left, our book value, is this. So this is for, was it 2015? Yeah. Okay. So then 2016 is when we sell it. Well, we need to depreciate it to the day that we actually go ahead and sell it. So if we were going to do a full year's worth of depreciation, it would be 2,880. Well, we sold it October 31st, so we don't have 12 months worth of depreciation. We have January, February, March, April, May, June, July, August, September, October. We have 10 months worth. So what I need to do is I'm going to go ahead and take this, divide by 12, and then take this and multiply by 10. So we need to depreciate it by 2,400. So let me change this to 2,400. And then this minus this. So our book value at the time of sale is 4,800. Go ahead and delete this. So what we need to do is go ahead and record how this is going to work. Okay. So we need to write off the full cost of the asset because that's what's listed on our balance sheet is 12,000. So I'm just going to call it, I'll call it a fixture, I think is what it was. So fixture. Now, when we bought it, we debited. So I'm going to credit it just to zero it out. And then we have in depreciation a total of 7,200. So accumulated depreciation. Now, accumulated depreciation is a credit. So to get rid of that, I need to debit. Okay. And lastly, we received 5,900 in cash. So cash, 5,900. Okay. So then what we need to do is tell ourselves, well, does this balance? Well, this balance, I can't see it because of the recorder. This is 13,100 and that's 12,000. So we're 1,100 off. We need 1,100 over here in order to make it balance. If it's on the credit side, it's a gain. If it's on the debit side, it's a loss. Because if you think about it, a gain is on the same side as revenue when you're recording revenue, and you always debit an expense. So if you have a loss, it's going to be on the debit side just like an expense would be. So here is our gain for this one. Okay. Let's see. I think we can go, well,